Hello and welcome to AXA Web TV. I'm Frantz Wenzel, Head of Investment Strategy, and we're very pleased to welcome Eric Chaney, Group Chief Economist. Hello, Eric.
Hello, Frantz.
Eric, most recently, leading indicators indicated that the economy is turning to the better. What would be your take on that?
Absolutely. Look, Frantz, we realize now that the global economy was in a soft patch for most of the second quarter and the third quarter of this year. And as you said, there are now very positive signs coming from three very important economies. First of all, from China. Second, from the US. And third, from Germany, that the soft patch is probably over. So let me start with China. Something that we have learned during the crisis and during the recovery is that when China is slowing, that's bad for the global economy. When China is reaccelerating, that is very positive for the global economy. The reality is that the recovery was driven largely by the resurgence of Chinese imports in the second half of 2009, first part of 2010, and there was a quite significant slowdown of Chinese imports, I would say from May, June. And that has led to this soft patch of the global economy. Now, the signals from China are about a reacceleration. Let me explain that. The Chinese PMI, which is probably the best coincident leading indicator that we have at hand, has signaled that orders are accelerating again. But the interesting thing is that these orders are not coming from the export side. I mean, everybody is thinking of China about an exporter, but it is also a very large domestic economy. And this time, the increase in orders is coming mostly from domestic orders. So my take is, we had this slowdown in China, which was to some extent the boomerang effect of the big stimulus that China implemented last year. And that was dangerous for the global economy because, as I said, if China slows too much, then it's a problem for the global economy. Now, domestic demand seems to be reaccelerating again. And when you look at the reaction from the Bank of China raising interest rates, that shows that the Bank of China is extremely confident about the robustness of its own domestic demand. So China is doing better. Second, in the US, the ISM survey was a surprise for every one of us. It is showing a rebound in orders. Our surprise gap is also popping up, signaling the possibility of a reacceleration of the US economy.
But let me jump in with one question here. Now, we learned from the president of the US Fed, the Fed is doing an additional quantitative easing. Now, you're saying that the economy is already accelerating, and on top, the Fed is basically really coming to the rescue of an ailing economy. How would you reconcile this?
You're perfectly right, Frantz, but actually the Fed decided to go for another layer of quantitative easing in August, when the US economy was in a soft patch. And the Fed is looking at unemployment, which is still very high. So there are still a lot of justification for doing more in terms of monetary stimulus. But I will come back to this. And let me just finish with saying that in Europe, the business surveys, such as the ifo survey, were also a surprise. They were not signaling any slowdown, but rather a reacceleration of the economy. So when you have these three economies, China, US, and Germany doing better, you draw the conclusion that the global economy is getting better. Now, let's talk about this quantitative easing, which is triggering a lot of debates, including at the G20 in Seoul. Here is my take. What the Fed has done so far apparently is working to support the components of domestic demand which are sensitive to interest rates, such as consumer spending in durable goods, which was up in the third quarter, or corporate spending on equipment goods, IT and software. The Fed wants to do more because it already has the evidence that it works. It's not, a miracle, but it works. The Fed wants to do more to be sure that there will be no double dip and to have an acceleration of the economy going forward, which would allow the unemployment rate to go down. And given the difficulty of the relationship between the Fed and the US Congress, you might understand why this unemployment issue is so important.
Yeah, sure, and I understand. Unemployment in the US is very important.
Yeah. So the conclusion from this macro analysis basically is that, okay, the global economy is doing better. On top of that, the Fed is increasing its action. There will be spillover effects on the rest of the world. especially through the channel of emerging market currencies, which are benefiting from capital inflows. We know that this is raising issues that emerging markets do not want to see their currency appreciating too fast, so there is a coordination issue. But basically, the important thing is that it's positive for the US economy. It is creating some risks outside of the US through this liquidity effect and the capital inflows into emerging markets. But on balance, I take the action decided by the Fed as positive for the global recovery. That is my conclusion.
Well, that's definitely good news, Eric.
That should be good news. And so let me turn to you, Frantz. We have been extremely cautious in our analysis of risky assets. So what do you make of this new landscape showing that the recovery is more robust than we thought in terms of asset classes and your call on asset allocation?
I think this is definitely very important and good news, what you just mentioned, that the global recovery is again underway via the three countries which you mentioned, expressis verbis. And also we have to add into that one that we think most of the risky assets, they're not only benefiting from this renewed liquidity action given by the Fed, but also we have long held the view that valuation in risky assets is definitely very cheap, and it is. So overall, we would take an assessment of that this kind of new landscape, as you described it, is fairly positive for risky assets.
So you mean that you are buying equities?
Well, basically, I think that's the punchline of it, isn't it? Currently, yields are in Euroland, they're 2.5% by and large. So longer-term investors, they will not really have a decent return on the government bond side, but where is the alternative? Well, the alternative is given a yield environment of 4 to 5% as far as dividend yield is concerned in equities, we think. And again, valuation, be it on a multiple basis or a dividend yield, is still fairly appealing. So our take in this kind of environment is clearly that investors should shift their focus towards risky assets, namely equities.
What about emerging market equities? I mean, if I follow the Fed action, and this idea that we have this liquidity injection not only in the US, but also in emerging markets, what does it imply for?
You're absolutely right, Eric, to raise this question. Emerging markets are most likely the biggest beneficiaries of this new liquidity action given by the Fed. They are reaping the benefits that the US is basically sowing, and that should be reflected in investors' landscape, i.e. in their portfolios. Hence our take, yes, buy equities, and in particular buy emerging markets.
What about government bonds? Is it now the moment where we should start selling government bonds?
Well, we would say presumably yes, but timing is crucial in that sense because we know that Fed action will remain.
Oh, don't fight the Fed.
I agree, but interest rates, short rates, will remain fairly low for a prolonged period of time. Hence, there is no immediate danger. In other words, investors can take time to sell bonds and shift into risky assets. Well, Eric, I think that was a very interesting discussion. Thank you very much for your insights, and thank you very much for listening into AXA and Web2B, and hopefully seeing you next time at AXA IM. Thank you very much.